Welcome to Global Money Talk, brought to you by Sampro TV. Greeting to all of our viewers from across the United States, Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Tai Wong, and joining me today is Larry Dyer, retired managing director with 40 years of experience as a fixed income strategist at several major Wall Street firms. Thank you so much for coming to the show today, Larry.
Thank you. Great to be here.
Oh, wonderful. So a lot to talk about today. I mean, we have the election, but let's start most importantly. We had a Fed meeting that, for the first time in my memory, was actually moved due to the election. So I'm sure you watched it very closely. But what are some of the key takeaways from yesterday's FOMC meeting, and most importantly, Chair Powell's press conference?
Yeah, well, I mean, there are only a few minor changes in the statement. The key thing is they cut the Fed funds rate by 25 basis points. But it's less what they did in terms of a market impact. It's what did they do versus what was expected. And they did pretty much exactly what was expected. So let's take that and put it to the side. I think that the next thing is what do we think the Fed is telling us going forward? And that was very fun because we've had talks over the time, and we've highlighted just the uncertainty in the Fed outlook, given the uncertainty in the economy and just how to model the economy. And I thought the press conference was very interesting because I think more than I've seen in other periods, Chairman Powell was really, really pointing to uncertainty. He mentioned uncertainty on the path. He mentioned uncertainty on the destination. His routine was kind of balancing out this thought process of you can trust us, we know what we're doing, equally with we don't know how the economy is going to behave, but we know our tools will let us get to this maximum sustainable employment objective and to moderate inflation, which they define as 2%. It's always fun to watch the press conference because you always see reporters trying to get the got you moment. And, he kind of batted those issues away. But, we've talked about the really wide range of opinions at the Fed, and that's something to think about. And the idea that they're kind of working their way through. It was fun. One of the got you moments was trying to get him to talk about, what does the change due to the election, going from a split Senate, Democratic president, to a Republican Senate, Republican president, and we don't know the outcome yet for the House. That could even go into next week. So a lot of uncertainty as to just what the fundamentals look like. But he was very important to sort of say, we're not modeling politics. We're going to see what's actually done. And there's a lot of noise around, in my mind, the outcome or the policies that we will see. It's easy to run for office and make a lot of promises. It's harder to potentially live with the consequences of them. So I'll always remember when Trump was first elected, he was running on hard tarfs very quickly, and he had a much more moderate speech, and 10-year yields backed up about 80 basis points in a couple of days. So let's keep watching the news flow and watching the market, but you have to, I think, have a very cautious view about just how much we know and when we will know it.
You're right. In fact, I remember Chair Powell saying that we will, when we have an idea of what's going on, then we will model that. And it's basically saying we're not going to worry about things ahead of time. But as you point out, we don't even know what the what the end game in the House, what the count in the House yet. It appears that the Republicans may retain a slim majority, but if they don't, then the House starts all spending bills. So
we saw a slim majority before, and they needed the Democrats to keep the government running.
I suspect they might have to do the same thing again. I think there's a part of that Republican caucus that will just, the last of the fiscal hawks maybe, who will absolutely not sign off on any new spending. So yeah, I think you're absolutely right.
May you live in interesting times.
I have to ask you this one. So, do you think that the election, even though he didn't say it, but do you think it's really now, and I think it was, to be fair, it was a toss-up, at least in most people's minds. has it really changed the thinking of the Fed saying, we don't know what it's going to be, but, and you know, they won't say it in the press conference, but we're probably going to have to change directions, you know, because, you know, this is going to be a very different administration.
I think they're ready to react to the data. They're always ready to react to the data. It's how much confidence do you have in the outlook? And also, the Fed is very willing, or historically are obviously very willing, to change just how they're talking about the market. Paul Volcker was saying, I'm running money supply. And we're tightening money supply to combat inflation in the early 80s. By 85, he was saying, I can't find a link between money supply and inflation. Right? Greenspan said that in the 90s. So now we're back to, QE, playing around with the monetary base, is somehow supposed to be stimulus, and QT not. And when you look at them, not much happened. You can remember 40 prominent Wall Street economists said QE is going to be very inflationary when it first came to pass. Wasn't, was it?
Certainly wasn't.
Now, I spent weeks looking at the numbers. It can't be. Banks just modified their short-term investment portfolio that they had for the liquidity, and they stopped investing in other short-term investments and took on reserves. The Treasury changed its policies. It issued fewer bills because when the Fed bought a 4% coupon Treasury, it paid the Treasury Department back a remittance, which was the 4% coupon minus the Fed funds rate. So the Treasury and the CBO model that as, we now have floating rate debt at the Fed, so they cut floating rate bill issuance. And you saw tight bill supplies and things on that order. When people talked about doing QT, everybody on Wall Street was saying, they're going to issue a lot more bonds because look at these, 5-year notes are maturing. They have to issue more 5-year notes to make up for it. Yeah, they issued bills.
Right.
So you can't just look at the headlines. The Treasury doesn't tell you what it's doing. It's not going to say, we're offsetting what the Fed did. You have to go do the work yourself. And that's, less common on Wall Street than we might like.
Let's go down the rabbit hole a little bit here. Where do you think, who actually decides on how on what to issue and what to weight it? And I know Treasury Secretary Yellen got a fair amount of flack from certain quarters that she did a lot of borrowing in bills rather than in the long end to try to keep interest rates down and for electoral purposes. But at the end of the day, I mean, Janet Yellen is was former chair of the Fed. Who actually decides on where to issue?
Well, this would be a whole a whole week of like quantitative analysis of what the Treasury's doing.
In summary.
But you go to the Treasury website and you can pull up their quarterly refunding meeting. You can pull up, here's how they analyze it. And when they look at it, if the Fed if the Fed issues a dollar bill, that dollar bill is backed by a Treasury at the Fed. Okay? And that's zero cost funding for the Treasury because the Fed buys a Treasury and the money goes back to the Treasury and the cost is zero. And that's historically how the Fed worked, and it maintained a lot of liquidity by having a good chunk of money in bills. And if you look at the Treasury issuance with kind of a stable situation, bills and short-term debt might be 30% of the Treasury's funding, a bit more than that perhaps. Then you'd have a 1 to 3 year bucket and further out. So they're looking at the evolution of funding over time. Now, if they need to fund $100 every year of increased funding, if they issue a 10-year note, it's generating $100 every year for 10 years before they have to refund it. If they issue a bill, it's issuing $100 of bills for a month, 3 months, or a year, whatever the maturity of the bill is. So you have all of these things rolling over in time, but generally the distribution, the maturity distribution and the fixed floating rate mix is relatively stable when they're in equilibrium. So that's important because when they're modeling the budget, right, the cost of funding varies. They assume 10-year notes might be 100 basis points more expensive than bills.
So,
and they just keep that. They're not trying to predict interest rates because it's difficult.
is there a senior civil servant who, I guess, makes the recommendation to be signed off by the Secretary of the Treasury? How does that work?
I don't have the complete insight. I just try to read the tea leaves.
Right.
I think there's a general acceptance that, if the Secretary of the Treasury wants to change things, they can. In the Clinton administration, interest rates were high, inflation was coming down. There was a choice to shorten the average life of the debt issued. In essence, borrow for a shorter maturity, rates come down, when the debt rolls over, you pay less. There's also a steep yield curve. So issuing shorter dated bills and notes increased your ability to sort of spend money without
it's sort of like
running up a deficit.
adjustable rate mortgages, right? If you can take advantage of the front of the curve.
Yeah, and so there are a lot of different things that happen, but it tends to happen either slowly. I can remember the Treasury under Trump 1 said, let's lengthen the debt because the coupons are relatively cheap, but I'd have to spend 2 or 3 weeks figuring out if they actually lowered the debt cost or not, because there was a lot of bills and holdings at the Fed as well that were floating rate debt. So my raw numbers, and I haven't redone this in a few years because I'm retired, but my raw numbers were they kind of kept the overall fix pretty close.
Great.
And the Treasury quarterly refunding gives you a mix. They've got how much is funded by at least last I saw, didn't look at the most recent one, they had how much is funded by cash at the Fed, how much might be associated with QE, and then here's the rest of it. And you still have to break out a lot of extra work beyond that to see what's happening. So you have several hundred Treasury coupons you model, you have several decades of how those coupons mature, you have a projection for the deficit, and then you say, how are they going to manage this mess?
Right.
So it's not fun.
So I know we were talking about this before the show, and there's a lot of, as you say, there's a lot of uncertainty in terms of what you promise on the campaign trail, and what you want to do, and you can actually do. So, and the Fed said we're not going to do anything until we see what's going to go on. But one concern is that if Trump extends fully his tax cuts, and I don't know if he'll get more tax cuts, but even if he fully extends the ones that he produced in 2017 beyond 2025 or makes them permanent, that's going to be a significant hit to revenues. And he likes to spend money. He's not really a fiscal hawk by any means, and he's talking about tariffs, which could hurt. Which could really, sort of hurt the economy. Do you get are you concerned about, a bigger deficit adding significantly to the national debt under the incoming administration?
Yeah, well, I'm a fiscal conservative, so the quick answer is yes. And then you get into how much will the market care.
Right, and that's what I'd like to hear you think of. Is there a pain point for the market?
There is a pain point, but nobody knows what it is. So you can look at different countries, look at how they've behaved over time, and try to benchmark the situation. Facts are stubborn things, but we can take a look at, an example of Japan would have debt to GDP of over 2 times for the government. So that's a fairly high number. You can look at different countries and you say, oh, their government is okay, but the private sector has a lot of debt. But that still is a promise for future that has to be managed in terms of how it's going to impact the overall government. We saw in the housing crisis that private sector debt is riskier than public debt because people generally expect the government can pay you back. So if you want to set up a number, you really can say, well, there's a point where people don't think you can pay them back. And at that point, life gets really ugly. But figuring out what that point is part psychology and part economics. Japan would be they have domestic savings, they're borrowing money from themselves, they're okay. The U.S. has a fair amount of its debt held by foreigners. So, excuse me. So look at the first QE. When Bernanke was writing about QE was going to fix things in 2002, Japan, making sure disinflation doesn't happen here. He said, we're going to buy bonds, and people are going to believe buying bonds will prevent disinflation, and therefore we won't have inflation. And the bonds we're going to buy, because we're the Fed, are treasuries. What bonds did they buy when they actually did QE? Mortgages. Why did they buy mortgages? Because if you look at the flow of funds data, you see foreigners were selling mortgages. Because Fannie Mae, Freddie Mac, and private mortgages were risky credits. And so they said, get me out. And mortgage spreads widened massively because nobody understood what the credit would be. Now, ultimately, I'd always say that the housing GSEs, Fannie Mae and Freddie Mac, were too cheap to save. Right? Because you can sit down and say, hi, I'm just going to X out the entire housing market in the U.S., and I'm going to go to the old private sector version, which would be 30 to 50% of a down payment in cash, and then a mortgage rate 300 or 400 basis points above treasuries. Gee, that'll make voters very happy. And what's going to happen to your home price if you have to put 50% down? You're not going to have a $200,000 or $300,000 home price. So they had to save the GSEs, and the GSEs had sort of monopoly power. But that's the inside the Beltway thing. Foreign central banks selling just mortgages, and they were a moderate part of the mortgage market, made mortgages uninvestable.
Right.
When people say, I don't think the government can pay me back, it can get ugly really quickly, and there are different periods you can look at for that.
Well, the example that comes to mind, we were also talking about it, was what happened to Prime Minister Liz Truss a couple of years ago in the UK. I think they tried to, her Chancellor of the Exchequer tried to jumpstart the economy with a £50 billion tax cut, and the bond vigilantes destroyed the gilt market. I mean, very different from where we, I guess very different from where we are. You know, they're not the reserve currency, but is there a sort of an object lesson there?
Well, I think there's a point, like, what happened at that point was, one, it was a bit of a surprise. Like, do not surprise the market, it doesn't like it. Two, it wasn't a sustainable storyline, given the structure. And there are also really crazy feedback loops with UK pension funds and other situations. So, as different parts of the insurance market, the pension market, and other things, they had a feedback loop. I sell, price goes down. Because the price goes down, I have to sell more. So they had kind of a mark-to-market margin call. We had a little bit of that. Actually, not a little bit. We had a pretty meaningful one. If you remember, during sort of the, I think it was around the COVID period, when the Fed came back with another QE and they said, we'll buy corporate bonds. Because when everybody deleverages at the same time, there is no price that clears the market. There's no, and the Fed has had to step in as a buyer of last resort in treasuries and mortgages. And in that case, they're looking at things like, oh, well, if everybody sells an off-the-run treasury, nobody trades an off-the-run treasury. So the Wall Street dealers get full up of off-the-run treasuries, and to clean up balance sheets, the Fed might have to come in and say, well, I can take those off your hands.
Right.
And then there's a repositioning. So all of this is kind of inside baseball kind of storylines for people, but you have to add together supply and demand, and if there's a break, you hope that there's a fix. Now, Liz Truss was funny because you said it destroyed the gilt market. It didn't. If something cannot go on forever, eventually it will end. So the policies that were proposed by Truss's government were unsustainable borrowing, the solution was pretty easy. Don't do the borrowing. So within a matter of weeks, they'd repositioned, and you had this big, choppy trade in gilts with a big downtrade and then a big rally, and maybe a little bit of a higher equilibrium rate because, gee, as an investor, I trust these people less to do the right thing. But it didn't end because the government couldn't afford to have the consequences of its decision.
Mm. Your point is well taken in terms of it was a surprise and there's a big feedback loop on how that the UK economy works. And I want to put you on the spot, and it's easy for me to do it, but in terms of, you mentioned earlier that the Japanese are probably still around that level where their debt to GDP is probably 2 times. 2 times. The U.S. is somewhere probably 1.25, 1.3. The UK was only 1. With us being the reserve currency, is there a number? Is it 2 times? Is it 3 times debt to GDP ratio where we start to get auctions that become very problematic, where we can't get enough buyers for our debt? I know it's hard, but I'm gonna any just thoughts?
I played with that, right? You can sort of play a little bit of game of how do you want to look at the world. It really comes down to and we saw this with the Liz Truss moment, if it's easier to fix than to live with the consequences, you'll fix it in some way, shape, or form. So for the U.S., one of the reasons we're running a large deficit, and we've accumulated a large deficit, is we've had a large number of corporate and individual tax cuts. Now, nobody treats the U.S. as if it was a stock and a bond. Like you could look at, whether you're looking at Tesla, whether you're looking at Microsoft, pick a company, there are hundreds of analysts looking at it and saying, what does their business model look like? Can they fix it? Are they charging enough for their product? If Apple sold the iPhone for $100, it costs more than $100 to make, right? Wow, the stock should be in real big trouble. But if Samsung is selling their phones for $1,000, Apple could sell their phone for $1,000, you can fix the problem pretty easily. So when you look at the U.S., you can say, oh, there's a deficit. Let's break it down and look at the U.S. versus its competition. Spending is comparable to the rest of the organization, to the median for the Organization of Economic Cooperation and Development. So federal government's at 23%, but different governments spend different stuff. So the OECD looks at federal, state, and local government, and the U.S. comes in something around 36%. You can look at the data differently and get a higher number, but that's a lot. Almost 4 out of every $10 in the U.S. is some form of government spending. Okay. State and local governments tend to balance the budget. The U.S. is running a deficit of 6% a year. If GDP is growing at 6% a year, debt to GDP doesn't grow. If GDP is growing at 4% a year, it grows 2% a year. So here, oh, the deficit is 6%. That's horrible. Debt to GDP, which is the better measure, is going to grow at sort of 2%. It's a lot less scary, isn't it?
It is.
And this is the kind of stuff that you have to go through. Now, if I look at the revenue side, U.S. is kind of median on spending. Where is it on revenue? Bottom quartile. So why is it in the bottom quartile? State and local governments balance the budget, so it's all the federal government taxing less than other governments. Make me dictator for a day and say we want you to fix the U.S., and it's pretty easy to fix. Corporate tax revenue as a percent of GDP is 3% less than the OECD average. Nobody likes paying taxes. You ever say somebody come up and say, please increase my taxes, right? You're not charging enough.
Not even Warren Buffett wants to
He
do
says,
that.
you should increase my taxes, but I'm not going to give the money away. I want to be rich. If I give my money to the government, I won't be richer than the other guy. So you can just look at the corporates and say, oh, we get 3% of GDP normalizing that. Maybe it's only 2%, but that goes to the debt to GDP isn't growing. Now, if you look at taxes in the 50s, the marginal tax rate for extremely high income people was 90%. They had ways around it, but guess what? If they're going for 90%, you're not hiding all of it.
Right.
Right. And people loved the 50s, right? You could work with a high school education, afford a home, a car, wonderful lifestyle, and it wasn't the tax rate. It was basically the U.S. was the largest, healthiest economy, and there was a relatively flat income distribution, and so people were reasonably able to consume. What happened is, as we became a global economy, things are different. For years, I would ask clients and different official people, have you ever looked at a global Phillips curve? And the answer is always no, and the reason is normally we take work from academics. Academics want to run a big statistical model and get a nice answer, and it's easier to do locally. So the Taylor rule uses the U.S. unemployment rate. But if you're a company, what do? Well, I can look at manufacturing companies where the CEO would say I can pay $20 an hour in the U.S., $8 an hour in Mexico, and $8 a day in China. That was in the early 2000s. In 1978, when GM was negotiating with the UAW, it said, you guys are getting 24 bucks an hour, the Japanese auto workers are getting 11, and they're more productive than you. It's a global Phillips curve. That's helpful, and that's how you see different countries develop, but that hollowed out the U.S. industrial base. We can go back to, sort of the Rust Belt and the anger in many workers. It's that the U.S. basis is different to the global basis. And we don't have an easy solution for that, but that's why we have, I think, going to the politics, Clinton was the economy stupid, Bush was 1,000 points of light, Obama was hope, Trump was make America great again. There's been an angry middle class working class for a very long period of time, and it's reflective of how do you balance out these different factors and how do you make life reasonable.
It didn't become a problem until it actually became a problem, and I think that's unfortunately in a democracy. You don't get to be dictator for a day. We may be better off if you were, but maybe you can get a job with the Trump administration.
I don't. But the thing is, it is fixable.
It is fixable.
It is
which
fixable,
is really
and
that's a great sort of silver line.
It is fixable, and that makes it really hard to say what point do you say it's not fixable. Like we can talk of those every year you get a little statement from Social Security saying in 10 years or 15 years or whatever the number is today, your Social Security is going to be cut by 20% because the income is not going to pay for the outflow.
Right.
So are you going to win Florida if you've cut everybody's Social Security by 20%?
100% right. So I mean, that's very encouraging in that it is fixable. It'll probably be raising revenue instead of cutting spending, which is harder, but at least there's a solution. But I do want to go back, because I know our viewers want to hear about what you're thinking about the economy as it stands right now. So how likely do you think there is a soft landing, or will we even have a soft landing?
Well, I think obviously a great question. The Fed forecast is always a soft landing, and the easy thing as a strategist or an economist is blame the Fed if there isn't, right? So there's always the story of, expansions don't end, the Fed kills them. But you can look at history and say, well, wait a minute. The Fed was created so it could get blamed for bad outcomes. But maybe if we look at history, we can pull up a chart.
Sure.
and hopefully it can point to different features. And
can we get slide 1?
Well, you're the expert, not me. There we go.
Oh, sorry.
No, you want to go to
slide 2. My apologies.
I think we're going to be 3 or 4.
Is it 3 or 4? Oh boy.
Oh, yeah,
let's try slide 3, and this is my fault here.
Okay.
There we go.
So this is the Fed funds rate. That's the blue line. I hope this is visible. I know what's not visible is the dates, but this is going from 1985 on. So this is from after Volcker said, hey, we've got the tools to kind of knock down inflation if we need it. And we start going through here. So from 1985, we see jiggles. At one point in there, you see a drop in 86, which was the stock market crash, 75 basis point ease after that, several hundred basis points of tightening to go onward. The Fed started easing, but then we see the recession and the very rapid easing around that gray shaded area. What caused that? Well, you had Drexel Burnham Lambert of the dominant firm in high yield go bankrupt. You had the Iraq war with a spike in oil prices. And you had the thrift crisis, which started in the 70s, finally resolved by the Resolution Trust Company coming in and spending $50 billion from the government to take over and just, resolve thrifts that were not going to be able to earn their way back out of trouble. So you basically took out a good deal of the U.S. banking system, and people talk about Brady bonds. You still had money central banks suffering from the 1983, I think it was, Latin America debt crisis, where they had booked lots of losses and had to reposition and get more equity. So all of those things, I'm going to make a point, wasn't the Fed.
I mean, I think that's a good point to make, because I think people, I have certainly heard that, and I don't know who came up with that. That the expansions don't die themselves. It's the Fed that does it. But it seems like it's a lot more really the excesses of other things that cause it, and not the Fed. Which is, I think the Fed gets takes a lot of lumps for doing actually probably a pretty good job.
Well, if you're having a bubble, like you take a balloon and you pump it up, if you keep pumping it up, it's going to explode. Maybe the Fed makes it a little less loud by popping it before it explodes on its own. But we can look at a couple other features and just sort of nail the situation. Hopefully give people an idea that you really have to look for the excesses. And I'll just go back to the chart and do that quickly, and I'll go through the soft landing as well.
Okay.
So if we go back to just that
we get
one
that chart back again.
Chart 3?
Yep. There we go.
Okay. So next recession and big Fed ease was 2000s into 2003, 2004. Well, what happened at that time? In 2000, you had the internet bubble burst, but the Fed was still actually not reacting to that too much, because that was a case of, what's an internet bubble? You buy, we're agreeing to buy a stock, pets.com. You think it's worth 500, I sell some other stock and buy it, or I say, no, it's worth 6, and you're like, great, it's 6. You're just arguing about what the price is, but the money isn't necessarily flowing in as long as you're willing to kind of validate the pricing. It's kind of different to the normal thing, but I've heard people say, I'm going to sell T-bills and buy a stock. Well, somebody else is buying the T-bill,
right,
and somebody else is selling you the stock. So the pricing is reflecting what the people trading the stock think it's worth. And if you get a bubble, it can go out. Now, going further, you had WorldCom and you had Enron. All right, now that caused a corporate bond problem because they were manufacturing cash flow. Accountants thought that was impossible. Right?
So, okay, if you have a segment, a unit in the Caymans that can manufacture, right?
Yeah, and then you went into the accounting crisis, so nobody could trust corporate earnings. They had a big slit on. How can I lend you $1 billion to expand your plant when I don't trust your accounting? So that was a big hit. So you had several different issues kick in at that point, and the Fed eased down to, what was it, 1%. And that was thought to be a bottom. And then the Fed began tightening again. And what were people doing when there was a 1% funds rate? You had the beginning of the mortgage crisis. Right? I'd mentioned some of the old school mortgage statistics. What did you do when the funds rate was 1%? Well, you had liar loans, you had subprime loans, you had oh, here's a 3% subprime loan that resets to 8%. Don't worry. In 3 years, you can refinance at 3%. The Fed's going to be low. Well, the Fed went up, so that caused a problem in housing. Um, and eventually that housing issue burst, and we had the Fed begin easing, hit the recession, and then go all the way to zero. Why was the Fed funds rate low for so long? Well, the person to qualify for a mortgage in 2003 could have no income and a 620 FICO. To qualify for a mortgage in 2011, you needed a 720 FICO. That took out 30% of the people that qualified before. You needed to make a down payment, something on the order of 10%.
Probably took out another 10 to 15% of the people.
Yeah. And you just had that situation hold up for a prolonged period of time. So you had a huge headwind from housing. And in the most recent period, we could look to that and would say, well, wait, COVID was a big deal. And COVID was met with enormous fiscal response, which made it a much smaller deal. It was met with bottlenecks, which created inflation. But we had a relatively short recession because there was an offset. So when we look at the economy today, do you see something like a crazy amount of credit being extended to homeowners or a big piece of the economy? No. Do you see really poor credit in the corporate sector? No. Spreads are pretty tight, reflecting a comfort level. Could something eventually grow up and cause a problem? Yes, but it's not obvious what that problem is going to be, right? So I can look at, we needn't go into some of the other charts that we had, but that's the thing that we have to look at. You pointed to, at some point, maybe the government borrowing plans are just unacceptable to investors. That's fixable.
Right.
Clinton came through with a, spending cuts and tax cuts. Obama and Boehner came up with a multi-trillion-dollar adjustment to taxes and spending. It was shot down because this divisive political environment has been running for a long time. It's not good for the country. It's not sustainable. So eventually something hopefully will end it. But that's the thing that we look at today, is it is sustainable for now. Right. We're going to see debt to GDP grow slowly enough that it's not a Liz Truss moment given what we know. Could it become one?
Hopefully, maybe we're wiser than that. I do want to ask you, and our viewers are interested in this, in terms of the short-term rates and perhaps the benchmark 10-year yields, where do you see them in the next sort of 3 to 6 months as this new administration gets inaugurated, starts doing some things? They may not have all their policies ready. They may throw on some tariffs. How are you looking at yields? Are you seeing any opportunities in the front end or in the 10-year, the back end?
Well, I mean, most of the policies that I'm seeing discussed so far, I don't know that they really change real GDP a great deal. Okay? If you want to create jobs or build GDP in the U.S., you somehow would have to say, well, we're going to become more productive. Right? We're going to become more productive than the rest of the world. We're going to somehow change fundamentals, right? Technology is one of the features that drives productivity. Somebody might say AI. I don't know. You're replacing a call center that might be in India. Right? Some of the great things in AI that you see, like the Nobel Prize in Physics was awarded in an AI-related feature. There you have the world's greatest physicists using some of the most powerful computers in the world to solve a specific problem. Are you going to put the world's greatest physicists to work to some other kind of component and solve some kind of problem? Let me, should have turned that off.
We're about to
Sorry
happen.
about that. Edit that one out, please. But, I think it's an important component, but it's not clear to me that it's really thinking. It can make you a bit more productive. That can be a positive, but it's not really, it's evolutionary so far. And I don't know that we're going to get the Terminator kind of an event of the computer smarter than us,
Right.
because it's doing what it's told. It maybe you can tell it to do something more exciting. It's certainly creating a big buzz in the stock market, but so did the internet, and you know how that turned out.
It turned out pretty well, pretty well. So any great opportunities? I mean, I bought a little TLT yesterday. I mean, are we? It seems like it's a little overdone.
Well, I mean, going back to your thing, but
Yeah.
what happens if you don't change GDP, and the Fed is maintaining inflation? We saw the 5% area in the rate market was able to push inflation down from 7% or higher to, depending upon the measure you want, using Chairman Powell's statements, 2.7, 2.3 for core PCE, whether you look at 3-month or whether you're looking at the higher level, 12 months. So inflation is getting pushed down by, I think, the dynamics in the economy. People can't spend money they don't have. The stimulus is coming out. Inflation expectations are anchored, and the Fed has the tools, and this is the big thing Powell said. I don't know the pace we're going to paraphrase Paul. I don't know the equilibrium rate we're going to, but I look at how the economy is behaving, and we have the tools to maintain our objectives. Their objective is not a 2.5% long-run funds rate. It's not a 3.5 long-run funds rate. It's a sort of a soft landing in the economy. We've had that before, and we've had that when the economy didn't have massive excesses. That was the 94 period in the previous chart, from the Fed tightening in the 90s up to about 98 or beyond with the long-term capital easing. The economy was well balanced. The excesses came into play with the internet bubble and with the accounting scandals and sort of too much finance. And I think we also saw with the Schiller Cape that the 1999 period had a really, really highly priced stock market, which ultimately, went for a 10-year period before it returned to the previous highs.
We were talking a little bit about that Schiller PE, which is it's a cyclically adjusted price earnings ratio. The fact that it's we're at highs, at almost historic highs, other than 1999, does that really give you substantial pause about where the equity markets stand right now?
I mean, if I'm an equity strategist, I can say it's rich and it can stay rich and get richer. So that's point A. Point B is Warren Buffett is selling stocks.
He is.
Right.
$325 billion in cash and doesn't know what to do with it.
He does. He can wait for a while. Maybe if rates back up a bit, he might decide long bonds are appropriate for him to sort of take a view as to where do you want to be in a 4% Fed funds rate or a 5% bond. Maybe he'll think that level makes sense. I don't know. But the thing you face is that certainly they're not cheap. And at this level in 1999, like I said, you had kind of a flat stock market or down stock market for 10 years. Flat isn't great. Down is not good. And that's the thing that investors have to deal with. Maybe this time is different. We do have, like, corporate profits as a percent of GDP are 3% higher than in the past. But maybe that's related to lower taxes. I mean, there are different components in here, but let's distinguish between the stock market and the economy. I'm a bond guy. I worry about the economy right now. I think the economy is okay. I can't give you the catalyst for the stock market. I can't give you the catalyst for a shift in the bond market. I can look at it and say, what's the balance of risks? Okay, stocks could be flat for a number of years, and suddenly that Schiller PE would look attractive. That's not a bad outcome for stocks, but it's not a great outcome for investors either. Um, if I look at rates, if a 5% or so rate structure slows down the economy and slows down inflation, we're not going to see massive physical stimulus to the extent that we saw in the Biden stimulus and some of the Trump stimulus plans because of COVID. So we're going to have moderate, I think, growth. So if 5% is too high, something on the neighbor of a 3 to 4% range would reflect a little bit lower inflation than the early 2000s, which had a sort of a 4 to 5% 10-year note range. Maybe it's 3 to 4% as a longer run equilibrium. That might be 2 to 3 years coming. What happens if we do hit a recession? I don't know what will cause it currently, but you're pretty likely to see something related to one. If you really need stimulus from the Fed, think about all the people who have a 2 or 3 handle on their mortgages.
Right.
You're going to need a 1 or 2 handle on the 10-year note just to make those, gee, I can sell my house and not have my mortgage payment go up.
So it almost seems what what you might be pointing to is 10s at 430, maybe a little rich, but if we get towards the 5 ranges, there might be, it might be some
There's a limit. Yeah,
opportunities
there's a limit to how high rates can go from here. So you can think of it. What if there's a 20% chance that you touch 5% and rally, and there's a 10% chance that you're 3% or less, and the rest of it is maybe 3.5 or 4.
That
The
makes
expected
sense.
value is lower, and your risk may be reasonably well defined as to how much you could lose. And at that point, do you want to be in a long bond that could give you a 10 or 20% return in price over the next few years, assuming these rate numbers, you're hitting the lower end of the rate structure number, and is competitive with cash otherwise? Do you want to be in equities if there's a risk that they're going to have a relatively low return given history because of valuation?
Right.
You might still be saying, hey, if there's a 10% dip, it's good to buy stocks, but you can't buy the dip if you're fully invested.
That is also true. One thing I do want to get on to with this little time that we have left on the show is people talk about swap spreads a lot in terms of how they look at risk, and swap spreads seem to be relatively narrow now, right? If I'm right, what do you make of that?
Okay, this gets pretty geeky. Swap spreads at one point were LIBOR, which was a short-term funding rate.
Mm-hmm.
Because of the global financial crisis and gains in the LIBOR market, they switched to repo. Repo is a secured funding rate. So, in theory, if I buy a treasury and I fund it in the repo market, it's kind of pure expectations theory would say the swap spread should be right on top of the treasury rate.
Right.
They're a bit different because who uses swaps? Well, they're used for speculation. They're used for hedging. And so hedging flows can be very important. Under the old framework, you had a really funny thing. The 10-year swap spread was positive. The 30-year swap spread was negative. Does risk decrease if you go from 10 to 30 years?
Absolutely not.
Right answer.
Even I got that one right.
And historically, that wasn't the case. What happened was that large hedgers, if you're a corporation, 30-year money is almost equity. So if you can borrow, I was at one firm, they'd issued a 20-year bond. The treasurer was incredibly happy he issued a 20-year bond. That's the longest bond they ever issued. And I had a meeting with him and sort of the head of the fixed income department. This was in the 80s. Look at where yields were. And it's like, it was actually late 80s, so look at that really high peak. It's like, why are you borrowing for 20 years? I've locked in the money.
At the highs.
Yeah. So it comes up. What are you going to do? Well, you can receive fixed on a swap. And then no one can ever take that money away from you. you'll be retired or dead by the time this could ever be a problem, and you've turned it into floating rate debt for 30 years at a very low spread. How many people want to buy a 30-year floating rate bond?
Right,
It,
right.
at the time, I had to help value them. They'd trade in a point, 2-point range, whereas a regular bond would trade in a quarter point. So you paid a lot to borrow floating rate for 30 years, but if you borrow a 30-year fixed rate bond and you swap it, it's cheaper than doing the alternative, and it's almost like an equity to a corporation.
Right,
So if
right.
I gave you equities at 30-year treasury at Fed funds plus 200, and you're playing Fed funds plus 50 for 3-month money, and that's almost equity, which is Fed funds plus 6%. When you say, gee, I should go get me some 30 years. Issue some 30
There's
years.
something to be said for that.
So this inside the game stuff, right? When you're looking at spreads, it's really the hedging demand as much as anything else. People talk about, Fed expectations, etc., but it's very easy to say I can do a 2-year swap against a 2-year treasury, and there's a relatively tight spread.
So so that it shouldn't really concern, on the face of it as much, but swap spreads are
Corporate bonds,
narrow.
mortgage spreads, those are real money to real people. The swap market is much more professional. If you want to, you can easily buy a treasury bond. If you own it, you can easily sell it. Go try and get a swap.
And the last question here, corporate bonds, they're pretty tight to treasuries right now. Any concern, any indicators flashing to you that where valuations are pretty high, we have a fair amount of unknowns coming up, that corporate bonds are relatively tight to treasuries. Any concerns?
The value story is, in the long run, there's more, there's a potential downside. But it really is a routine of think about, you'll often have people go, oh, the spread's widened 10 basis points. I got a different question for you. For professional, you're buying a corporate bond, most likely instead of a treasury or versus a corporate index. So not buying the corporate bond versus the index is being short corporates. Do you want to be short yield? Buying the corporate bond as an overweight versus treasuries is, are you going to make money with the corporate bond? So if you buy a 2-year corporate bond instead of a 2-year treasury, the spread has to double in 1 year because it becomes a 1-year. So if you earn 50 basis points on it, the spread has to go to 100 in 1 year, and you have to say, that's my break even. To balance out my loss if nothing happens to my loss if something happens, maybe I have to expect the spread to widen 100. Right. That's a big move. You don't want to do that. Now, same token, let's take a 30-year bond. 30-year bond might yield 100 basis points over treasuries. It's a 20-year duration. Suddenly, a 5 basis point spread move on a 20-year duration is 1 point. So your income is offset by 5 basis points. So the long end of the market at tight spreads, when you think of, gee, they could widen 100, it's dangerous. Now, if I'm a professional money manager, I might not want to be short at these points, but I might not want to be long either.
Right. That makes a lot of sense.
And I might say, gee, maybe I should start gaming my positioning to avoid the riskier long duration stuff. But I don't think most regular investors are playing this game. And if you're an insurance company, you want to book the income, and how are you hedged? If you buy a life insurance policy and I'm an insurance company, I price your insurance policy based on where the 30-year corporate bond spread is. So my hedge is to sell you an insurance product, not to speculate in the treasury market or to speculate in the corporate spread market. So it's a different game. The spreads are relatively tight. The economy looks relatively good. And I think that combination says, for the foreseeable future, spreads stay here. And what you want to do with spreads really depends as much on what kind of investor are you. As an individual, I might not want to buy a very long duration corporate bond fund today.
But there are folks who will. There are folks for whom it makes a lot of sense.
Yeah, and I might say, gee, in that case, bonds themselves or a bond index like, the 20-plus year index fund that we'd spoken to earlier. It might be something that you want to look at over time. On equities, a lot of the price action that we've seen, your equity guys will tell you, has been in tech, and it's been associated with, with AI. Now, if AI is real, that's great, but you're not going to invent AI again. So the extraordinary returns are not repeating. If AI is less good than people think, then there's some risk profile, and the generic numbers are kind of okay, but maybe, Rich, you can look at how finance is done after the election.
Right.
Bank stocks were up 10+% in a day. That's not a common occurrence, and it's not clear how long that situation holds up.
Well, I think we're going to talk about that the next time we have a conversation, hopefully in the not too distant future. Thank you so much. And that will do it for Global Money Talk, live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SomPro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us. We'll be back here on Monday. Have a great weekend.